Let's check out if this sounds a little bit familiar. You have some money sitting in a savings account and it's probably earning little to nothing and you have no idea what to do with it. There are several options available to you. One option is you could go to a traditional bank and put your money in a savings account or money market account. There's a good chance they won't pay you anything. And if you were getting paid, then you wouldn't be here watching this video. Hello everyone and welcome back to the Finance Guardian channel. If you've been stashing your money at your local bank, you might not have seen any growth in your return. It's unfortunate that most banks are still paying interest on savings that's just a fraction of 1%. Just how small is that? The FDIC reports recent average rates of 0.6% for savings accounts and 0.8% for money markets. As the inflation rate climbs to 7%, its highest level in 40 years, you are losing money every day it sits in your bank account. Perhaps it is time to fire your bank and look for another place to keep your money. Take a look at these 7 options to earn much more. Hit that subscribe button and the bell beside it and let's get started. Option number 1, online savings. A few years ago, nobody would have thought of this option. Online banks would have seemed too risky. Also, most banks now offer online banking services. So what makes online banks more special? And why should you keep your money in it? The reason is that local banks' rates are not just higher, they are much higher. Unlike traditional banks, these banks don't have brick-and-mortar locations, therefore they don't have the overhead. They don't have the costs associated with running the bank. They don't have all the employees, they don't have the real estate, and they don't have all the expenses associated with that, so they should be able to pay you significantly higher rates than you would at a traditional bank. Having been around for quite some time now, online banks are becoming more and more accepted by the public. Since the beginning of the COVID-19 pandemic, interest rates have been relatively low, but high-yield savings accounts still offer higher rates than conventional savings accounts. For example, Ally Bank, Axis Bank, and Synchrony Bank all currently offer online high-yield savings accounts paying rates of 0.5% or greater, which is more than the average national saving rate of 0.6%. Option number 2, U.S. Treasuries. Aside from the fact that these securities pay more interest than local banks, they are also considered the safest investments on the planet. The U.S. Treasury securities represent government debt, and both principal and interest are 100% guaranteed by the U.S. government. Treasury securities come in a variety of forms that are primarily determined by the term of the instrument. For example, securities with maturities between 2 years and 10 years will be considered Treasury notes, whereas securities with maturities between 20 and 30 years will be considered Treasury bonds. But you're more likely to be interested in Treasury bills. Generally, these are short-term securities with maturities between 1 month and 1 year. They aren't as liquid as savings accounts or money market at your local bank, but they pay generous interest rates and are short-term in nature. Should the need arise, you could always sell them before maturity. Treasury bills have a recent yield of 0.78% for 1 year. Treasury securities come with the additional bonus of being exempt from state income taxes in conjunction with their high yields. You may be able to get a slightly higher interest rate on longer-term securities, but it is not worth the extra interest if your money is tied up for anywhere from 2 to 30 years. Option number 3, high dividend stocks. Using this for your savings account might not make sense, but if you have enough money in your emergency fund, then you might consider it. There is, however, a certain amount of risk involved. There is no guarantee that just because a stock pays a dividend, it will no longer lose value. Anything can happen. Then again, if a stock pays a 3% dividend or a 4% dividend, or if you're looking at a limited partnership that pays 7, 8, 9, 10, or even double-digit dividends, then obviously that's paying much more than the 0.5% yield you'd find in an online savings account. There is even an elite group of dividend stocks referred to as dividend aristocrats. Dividend aristocrats are stocks that meet the following criteria. They are a part of the S&P 500, they meet certain minimum liquidity and size requirements, and they have increased dividends consecutively for 25 years or longer. It is particularly important to note the last point. While it is true that even high dividend yield stocks can lose value, they can also gain in value. Stocks that consistently raise their dividends are some of those with the best long-term appreciation potential. Because of that, you will not only receive a high dividend yield, but also have a chance to see the stock's value increase over time. Where will you do this? Many discount brokerage platforms offer high dividend stocks, including Ally Invest, TD Ameritrade, Charles Schwab, and Fidelity Investments. It's even possible to trade stocks commission-free on a site called Robinhood. Option number 4. Bonds. This is a slightly more traditional option. What we're talking about here is the opposite of stocks, which are bonds. Bonds are long-term securities that pay higher returns than savings accounts. But it is crucial to understand bonds are not completely safe either. Their value can fluctuate just like stocks. This is why you are better off avoiding individual issues if you're going to own bonds. The ideal option is to buy bond funds via exchange-traded funds, ETFs, that are linked to indexes. Your bond portfolio will be professionally managed, so you don't have to worry about any single bond defaulting. Let's focus on two types of bond funds: high-yield bonds and municipal bonds. Over the past few years, rates on corporate bonds have not been very high. However, high-yield bond funds hold portfolios of higher-yielding bonds as a result of higher risk associated with the issuing companies. Such funds can offer high returns on short-term investments. An example is the iShares iBox Dollar High Yield Corporate Bond ETF, which has paid a yield of 3.14% over the past 12 months. Bonds issued by states and municipalities are called municipal bonds. In contrast to high-yield bonds, these bonds have lower interest rates, but the interest earned is tax-free for federal tax purposes. You will also be exempt from state income taxes if you live in the states where the bonds are issued. ETFs are also the best way to own municipal bonds. iShares National Muni Bond ETF, for instance, paid tax-free interest of 1.92% over the last 12 months. Option number 5. Blended portfolio. This is an innovative approach to getting a higher return on your savings. You can create a blended portfolio that includes both stocks and bonds, but mainly bonds. By combining the two, investors can take advantage of the relative safety of bonds while still earning higher yields from stocks. You could create a portfolio that consists of 80% bonds and 20% stocks. If you want to be a bit more aggressive, you could invest 75% in bonds and 25% in stocks. A portfolio such as this is more risky than CDs or treasury securities, but it has the potential to yield higher returns. Besides getting interest income from the bonds, you can also gain capital appreciation from the stocks. It'll boost your return at least a little more than what you'd get on interest-only investments. This is also not necessarily a difficult process. Several automated investment platforms, also known as robo-advisors, can help you create such a portfolio. Among the most popular robo-advisors are Betterment and Wealthfront. In exchange for a small annual fee of 0.25% of your portfolio, they will create and completely manage your portfolio. Robo-advisors usually consider your investment goals, time horizon, and risk tolerance when evaluating your investor profile. Entering a short time horizon can allow you to allocate a large amount of bonds. As an example, if your horizon is 3 years, your portfolio will automatically be mostly invested in bonds. Option number 6. Real estate investment trusts. Real estate is another option for those who prefer not to invest in stocks and bonds. You can do this by investing in real estate investment trusts, or REITs. In a way, they're like mutual funds, but for real estate. They typically invest in commercial real estate like office buildings, retail stores, and apartment buildings. But some also undertake smaller projects, such as property renovations. An ETF is the easiest way to diversify across several REITs. The iShares Core US REIT ETF, for example, yields 2.47% today and holds more than 160 individual REITs. Crowdfunding platforms are another way to invest in real estate. Here, you can either invest in loans or equity positions in real estate deals. Several crowdfunding platforms exist, including Fundrise, Realty Mogul, and Rich Uncles. Fundrise is particularly appealing since it is open to investors no matter what their financial status is. They buy properties and you can invest for as low as $500. Investing in real estate in any form is not very liquid, so it's best used for money you won't need for at least 2 to 3 years. Option number 7. Peer-to-peer P2P lending. There is no other way to invest in fixed income assets quite like this. Through P2P lending platforms, you can invest money in loans taken out by borrowers. P2P lending is designed to remove the banker from the loan arrangement. Instead, it is you, the investor, who becomes the banker. Your investment consists of loans to individual borrowers. Now, the risk isn't as great as it may sound. You don't actually fund the entire loan. Instead, you are investing in what are called notes. Each note is worth $25. Those who borrow $25,000 from a P2P platform may have their loans funded by up to 1,000 investors, each contributing $25. This reduces the risk any investor has on a single loan. It also gives you the chance to invest across a wide range of loans. With just $1,000, you can invest in 40 different notes. More importantly, though, you can decide what level of risk you can take on. If you want to invest more aggressively, then buy higher risk, higher yield loans. Or if you want to play it more safe, then buy lower risk, lower yield loans. And that's all the time that we have today, folks. We hope you enjoyed this video, and if you did, please do remember to hit that like button. If you're new around here, welcome to the channel. Please do remember to subscribe, and on your way out, click on that bell icon too so you can remain updated about all of our future videos. You're welcome to the channel where you will learn the basics of personal finance in an easy to understand language. We'll see you next time.